One thing many traders struggle with when trading supply and demand or smart money concepts is identifying the correct zone to buy or sell from. In trending markets, price action will often create multiple supply and demand zones, making it difficult to determine which zone deserves the most attention. Failing to understand which zones to focus on and which ones to ignore leads to many avoidable losses. Traders often end up executing from the wrong zone, or even worse, attempting to trade every zone they see. This can result in 2, 3, or sometimes even more consecutive losses before finally catching the correct setup, a situation we want to avoid as much as possible. So, how do you actually identify the best zone to buy or sell from? That's exactly what I'm going to help you understand today. We'll be breaking down 4 key concepts that will help you accurately identify the zones you should focus on and, just as importantly, the zones you should ignore. Point number 1 is the zone efficient or inefficient. In trading, market efficiency or inefficiency generally refers to whether a supply or demand zone has been retested or not. An efficient market is one where the zones have already been revisited and tested by price. On the other hand, an inefficient market is one where zones are left untouched, meaning price has not yet returned to them. One mistake I see many traders make is trying to trade from supply or demand zones that have already been retested, whether by candle wicks or full candle bodies. These types of zones are typically considered low probability setups. Why? Because the buying or selling orders that originally caused the reaction at those levels have most likely already been filled. In simple terms, the liquidity at that zone has already been consumed, reducing the probability of a strong reaction if price returns again. It's the areas with inefficiencies or imbalances that are more likely to be filled and therefore more likely to produce strong reactions, because the buy or sell orders within those zones are still unfilled. So the first key tip when selecting zones is to focus on imbalanced zones. To identify an imbalanced zone, we're simply looking for supply or demand zones that caused a strong impulsive move and have not yet been revisited. Ideally, there should be no wicks or candle bodies trading back into that zone. For example, these zones are considered imbalanced while this one is not. However, in real market conditions, you will often find multiple imbalanced zones forming at the same time. And that brings us directly to the second point. Point number 2, extreme zones. In a typical price move like this, which is a very common market structure, you're often left with multiple imbalanced zones. In these situations, you now have more than one potential area to trade from, which can make decision-making a bit tricky. However, there's a general rule that can guide you and improve your consistency. Imbalanced extreme zones tend to carry more weight. An extreme zone is simply the furthest imbalanced zone away from current price within the current leg of price movement. So while you may have several zones along the move, the extreme zone is the one positioned farthest out like this one, while the others are standard zone. That said, this doesn't happen every time. To manage this uncertainty, we can approach the market in 2 ways. We can either place buy or sell limit orders at the extreme zones, or we wait for confirmation entries at the other zones within the same move. A confirmation entry, in my approach, involves waiting for price to reach the zone and then observing a shift in lower time frame structure from lower highs and lower lows into higher highs and higher lows. When this shift occurs, it signals that the microtrend is now aligning with the higher time frame direction, increasing the probability of a successful trade. Because of this, I tend to prefer trading from extreme zones, especially using limit orders, since they often provide better risk to reward setups and a higher probability of success. However, trading is always probability based. Focusing only on extreme zones means you will inevitably miss some trades, and that's simply part of the game. This is where confirmation entries become valuable, allowing you to participate in moves that don't perfectly reach the extreme level. Point number 3, strength of the impulse. In a trend, we usually see 2 types of price movement impulses and corrections. The impulse moves are the strong, directional expansions in line with the trend, while the corrections are the smaller pullbacks against it. When a zone forms as part of a strong impulse, a sharp, decisive move in one direction, that zone is generally considered high probability for future reactions. However, not all impulses are equal. If a zone is formed during a slow, choppy, and overlapping price movement, and later we see a different area where price delivers a strong, impulsive move, that second zone tends to carry more weight with the higher probability. This can slightly contrast the idea of always prioritizing extreme zones. The key nuance here is this: you want to focus on the strongest impulses, especially when they are responsible for breaking market structure. For example, in a given move, we may see an opened imbalance below price, but those zones are formed within weak, choppy price action and remain inside the previous structure. They are less significant because there was no real momentum behind them. Then we see a strong, impulsive move that breaks structure and pushes price into new highs. Even if this is not the absolute extreme zone, it is the area where the most aggressive buying pressure came from. That makes it the most important zone and therefore the one with the highest interest and probability of reaction. Final point: does your zone exist on the higher time frame? Depending on how long you've been trading, you may already understand that higher time frames generally provide more reliable setups. Why? Because there is less false moves, less intermittent noise, and price action is more smoothed out compared to lower time frames. Lower time frames show every small fluctuation between buyers and sellers, while higher time frames give you a clearer, more structured view of the overall market intent. A common mistake traders make is zooming in too far. For example, if you're trading a trend that is clearly visible on the 4-hour time frame, but you're only focusing on 5-minute or 15-minute zones, you can easily miss the bigger picture. Take this example. On the lower time frame, you may see multiple supply or demand zones and naturally start asking which one is the correct zone to sell from. But when you zoom out to the 4-hour time frame, you'll often find that only 1 or 2 of those zones actually sit within a major higher time frame area of interest. Using the liquidity concepts we learned earlier, we can see the pullback high as a liquidity. We identify the key level, the extreme point where price is most likely to react. In this case, after price sweeps the pullback high and shows intent with a confirmation without the order block failing, we can confidently place an order after the confirmation, or we can confidently place a limit order at the higher probability extreme zone rather than reacting to every minor lower time frame level. By doing this, the trade becomes much clearer and more structured. Instead of multiple conflicting setups, you narrow it down to 1 or 2 high probability zones. This reduces unnecessary losses, improves execution quality, and ultimately increases your win rate over time. So, in summary, the key concepts to focus on are imbalances, extreme zones, impulse strength, and higher time frame alignment.